Look, I need you to understand something that most people won't figure out until it's too late. We're standing at a threshold right now, a moment in financial history that doesn't come around often. And when I say we're approaching the point of no return, I'm not being dramatic. I'm being precise. Because there's a specific moment in every major market shift where the door closes, where the opportunity that was available to everyone suddenly becomes available to no one. And based on what I'm seeing in the gold and silver markets right now, based on the data that's coming through, based on the moves that major institutions are making behind the scenes, we're getting dangerously close to that moment. Let me show you what I mean. Right now, gold is trading at all-time highs, silver is showing strength we haven't seen in years, and the mainstream narrative is telling you this is a bubble, that precious metals are overheated, that you should wait for a pullback. But here's what that narrative is missing. This isn't a speculative rally driven by retail enthusiasm. This is something fundamentally different. This is institutional repositioning on a scale we've never witnessed before. Central banks just completed their third consecutive year of buying over 1,000 tons of gold. Think about that number. 1,000 tons. Every single year. For 3 years straight. That's not a trend. That's a structural shift in how the world's most powerful financial institutions view gold as an asset. And it's not just the usual suspects. It's not just China and Russia, though they're certainly leading the charge. It's Poland, it's Singapore, it's India, it's Turkey. Countries that historically held modest gold reserves are now accumulating at unprecedented rates. Poland increased their gold reserves by over 100 tons in a single year. Singapore, a country that barely held any gold a decade ago, is now one of the largest holders in Asia. Why? What do they know that the average investor doesn't? They know that the global monetary system is undergoing a transformation. They know that the dollar's role as the world's reserve currency is being challenged in ways it never has been before. They know that when you're a central bank, when you're responsible for the financial stability of an entire nation, you don't make moves like this unless you're preparing for something significant. But here's where it gets interesting. Here's where we start to see why we're approaching that point of no return. The physical gold market is fundamentally different from the paper gold market. When you look at the price of gold, what you're seeing is largely determined by paper contracts traded on exchanges like the COMEX. Futures contracts, derivatives, financial instruments that represent gold but aren't actually gold. And for decades, this system worked. The paper market and the physical market moved in relative harmony. But something's breaking down. The ratio of paper gold to physical gold has been expanding. Estimates suggest there are anywhere from 100 to 250 ounces of paper gold claims for every single ounce of physical gold that actually exists in COMEX vaults. That's not a market. That's a time bomb. And we're starting to see the fuse being lit. Look at what happened in the London bullion market recently. Premiums for physical gold over the spot price started spiking. Not by a few dollars. By significant amounts. Because when you actually want to take delivery of physical gold, when you want the real metal in your hands, you're discovering that it's not as available as the paper market suggests it should be. This is the early stage of what market analysts call a squeeze. When the paper price says one thing, but the physical reality says something completely different. And when that gap widens enough, when enough people start demanding physical delivery, the entire structure of the paper market comes into question. Now, let me tell you a story that illustrates exactly what I'm talking about. Back in the early 2000s, there was a German investor named Peter. Peter wasn't a conspiracy theorist. He wasn't a gold bug. He was a successful businessman who had accumulated wealth through real estate and manufacturing. But Peter was also a student of history. He remembered stories his grandfather told him about the Weimar Republic, about hyperinflation, about how quickly paper currency could become worthless. So Peter decided to allocate a portion of his wealth into physical gold. Not a lot. Maybe 15% of his portfolio. He bought gold through a reputable bank, got certificates. Everything looked legitimate. He felt secure. Then came the financial crisis. And Peter, like many investors, wanted to verify his holdings. He went to the bank and asked to see his gold. Not to take delivery. Just to see it. To confirm it existed. The bank told him it would take 6 months. 6 months to show him gold that was supposedly sitting in their vault with his name on it. Peter pressed harder. He wanted answers. And eventually, the truth came out. The bank didn't have his specific gold. They had pooled allocations. They had paper claims that exceeded their physical inventory. They had sold the same gold multiple times to different investors, assuming no one would ever actually want to take delivery at the same time. Peter eventually got his gold. But it took nearly a year. And he was one of the lucky ones, because he started the process early, before the real panic set in, before everyone else figured out what was happening. That's the point of no return I'm talking about. It's the moment when the music stops and everyone realizes there aren't enough chairs, when the paper promises can't be fulfilled with physical metal, when the system that's been built on leverage and fractional reserves suddenly has to deliver actual gold to actual people, and we're seeing signs that moment is approaching faster than most people realize. Look at the silver market. Silver is even more interesting than gold because it's both a monetary metal and an industrial metal. It's used in solar panels, in electronics, in medical applications, in water purification. The industrial demand for silver is growing exponentially, while above-ground stockpiles are shrinking. The Silver Institute recently reported that industrial demand for silver reached record levels, driven primarily by the solar industry. Every solar panel requires about 20 grams of silver. And with the global push toward renewable energy, with countries committing to massive solar installations, the amount of silver being consumed for industrial purposes is staggering. But here's the problem. Silver mining production has been relatively flat. We're not discovering major new silver deposits. The easy silver has already been mined. And much of the silver that's produced today comes as a byproduct of copper, lead, and zinc mining, which means silver supply is largely dependent on the economics of other metals. So you have surging industrial demand, flat production, shrinking above-ground inventories, and on top of all that, you have investment demand starting to wake up. Silver ETFs saw their first significant inflows in years. After years of outflows, after years of investors abandoning silver, money is starting to flow back in. Not huge amounts yet, but the trend has reversed. And when you combine investment demand with industrial demand in a market that's already tight, you create the conditions for a supply squeeze that could make what happened in nickel look tame. Remember the nickel squeeze? When the London Metal Exchange had to halt trading because prices went parabolic? When a single Chinese company's short position threatened to bring down the entire exchange? That happened in a market with relatively robust supply chains and multiple producers. Now imagine that scenario in silver, where the supply situation is far more constrained and the demand drivers are far more structural. But let's get back to gold for a moment, because there's another dimension to this story that most people aren't paying attention to: the geopolitical dimension. The BRICS nations, Brazil, Russia, India, China, South Africa, have been openly discussing alternatives to the dollar for international trade. They've been talking about it for years. But talking and doing are two different things. And recently, we've started to see actual implementation. China and Saudi Arabia completed oil transactions settled in yuan instead of dollars. Russia is selling natural gas to Europe with payment in rubles or gold. India is buying Russian oil and paying in rupees. These aren't hypothetical scenarios anymore. These are actual transactions happening right now, bypassing the dollar system that's been in place since the end of World War II. And every single one of these alternative arrangements involves gold in some capacity, either as a settlement mechanism, or as a reserve asset backing the alternative currency, or as a store of value that both parties trust more than each other's fiat currencies. This is why central banks are buying gold at record levels. They're not buying it because they think the price is going up. They're buying it because they're preparing for a world where the dollar is no longer the undisputed king of international finance, where having gold reserves gives you optionality, where gold becomes the neutral asset that everyone trusts when trust in paper currencies is breaking down. Now, I want to pause here for a second, because if you're sitting on retirement accounts worth $100,000 or more, this next part is particularly relevant to you. I've put together a comprehensive guide on how gold IRAs work. It's completely free. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, how the process actually works, what the costs are, what to watch out for. If you're thinking about protecting a portion of your retirement savings with physical gold, it's worth checking out. No pressure, just information that might be useful for your situation. All right, back to where this is all heading. Because here's what happens next. Here's the sequence of events that leads us past that point of no return. First, more investors start waking up to what's happening. They start seeing the same data I'm showing you. They start understanding that this isn't a normal market cycle. They start wanting to own physical gold and silver, not paper promises. Second, that increased demand hits a supply chain that's already stretched thin. Premiums start rising. Delivery times start extending. What used to take 2 weeks now takes 2 months. What used to cost spot price plus 3% now costs spot plus 10%. Third, some investors who thought they owned gold through ETFs or allocated accounts start asking questions. They start wanting to verify their holdings. They start requesting delivery. And some of them discover, like Peter did, that the gold they thought they owned isn't quite as accessible as they believed. Fourth, that creates a crisis of confidence. Not in gold itself, but in the paper gold system. People start questioning whether their gold certificates are worth anything, whether their ETF shares actually represent physical metal, whether the entire structure of the gold market is built on a foundation of promises that can't all be kept simultaneously. And fifth, that's when the real move happens. That's when gold doesn't go up 20% or 30%. That's when it gaps. That's when the paper market breaks from the physical market entirely. That's when you see gold trading at $3,000 on the COMEX while physical gold is changing hands at $4,000 in private transactions. That's when the point of no return has been passed. Now, you might be thinking, this sounds extreme. This sounds like fear-mongering. But let me give you some historical context. In 1971, when Nixon closed the gold window, when he ended the convertibility of dollars into gold, gold was trading at $35 an ounce. Within 9 years, by 1980, gold hit $850. That's a 2,400% increase, not over decades, over 9 years. What drove that move? It wasn't speculation. It was the realization that the dollar was no longer backed by anything tangible, that the monetary system had fundamentally changed, that the promises made at Bretton Woods couldn't be kept, and investors around the world rushed to protect their wealth with the one asset that couldn't be printed, that couldn't be devalued by government decree, that had maintained its value for thousands of years. We're in a similar moment now. Except this time, it's not just the dollar that's in question. It's the entire global fiat currency system. It's the realization that every major currency is being debased simultaneously, that there's no safe haven in paper money anywhere in the world, that the only real money, the only asset that can't be created out of thin air, is gold and silver. And here's what makes this moment even more critical than 1971. Back then, the world wasn't as interconnected. Information didn't travel instantaneously. Markets weren't as sophisticated. The derivatives market didn't exist in its current form. The leverage in the system was a fraction of what it is today. Now, we have a global financial system that's interconnected in ways that create systemic risk, where a problem in one market can cascade into other markets within minutes, where the leverage is so extreme that small moves can trigger massive liquidations, where the paper gold market has created obligations that are mathematically impossible to fulfill if everyone demands delivery at the same time. This is why I say we're approaching the point of no return. Because once this process starts, once confidence in the paper gold system begins to crack, it accelerates rapidly. It doesn't give you time to react. It doesn't give you time to call your broker and place an order. By the time you see it happening on CNBC, by the time it's the lead story on financial news, it's already too late to position yourself advantageously. Let me tell you another story. This one's about a fund manager named Sarah. Sarah ran a mid-sized hedge fund focused on commodities. She was smart, well-connected, had access to the best research and analysis money could buy. In early 2008, Sarah started seeing warning signs in the credit markets. She saw the subprime mortgage problems. She saw the leverage in the banking system. She knew something bad was coming. But Sarah made a critical mistake. She thought she had time. She thought she could wait for confirmation. She thought she could see the crisis developing and still have time to position her fund defensively. So she waited. She watched. She analyzed. And then Lehman Brothers collapsed. And within 48 hours, the entire financial system was in free fall. Credit markets froze. Liquidity disappeared. The moves that Sarah had planned to make, the defensive positions she wanted to establish, became impossible to execute. Not because she didn't know what to do, but because by the time she tried to do it, everyone else was trying to do the same thing simultaneously, and there was no liquidity, no counterparty willing to take the other side of the trade at any reasonable price. Sarah's fund survived, but it took massive losses that could have been avoided if she had acted on her analysis earlier, before the crisis became obvious to everyone. That's the lesson here. The time to act is before the point of no return. The time to position yourself is when you can still do so calmly, rationally, without competing against a panicked crowd all trying to get through the same narrow door at the same time. And right now, we're in that window. We're in that period where the data is clear, where the trends are obvious if you're paying attention, but where the mainstream hasn't caught on yet, where you can still buy physical gold and silver at reasonable premiums with reasonable delivery times, where you can still move a portion of your wealth into hard assets without fighting against a stampede. But that window is closing. Every month that passes, every new record of central bank buying, every new sign of stress in the paper gold market, every new geopolitical development that undermines confidence in fiat currencies, that window gets a little bit smaller. Look at what's happening with gold ETFs in Western markets. After years of outflows, we're finally seeing inflows again. Western investors who had largely abandoned gold during the long bull market in stocks are starting to come back. Not in huge numbers yet. But the trend has reversed. And when Western investment demand combines with Eastern central bank demand, when you have both retail and institutional buyers competing for the same limited supply of physical metal, that's when the market dynamics change dramatically. Consider the supply side for a moment. Global gold mine production has been essentially flat for years. We're not finding major new gold deposits. The ore grades at existing mines are declining, meaning miners have to process more rock to get the same amount of gold. The easy gold has been mined. What's left is deeper, lower grade, more expensive to extract. And it's not just about finding gold. It's about the time it takes to bring a new mine into production. From discovery to first production, a new gold mine typically takes 10 to 15 years. You need to do exploration, feasibility studies, environmental assessments, secure financing, build infrastructure, obtain permits. It's a decade-long process, minimum, which means the gold supply we have today is essentially the gold supply we're going to have for the next decade. There's no way to quickly ramp up production in response to higher prices. The supply is what it is. And if demand continues to grow, if more central banks keep buying, if more investors start seeking the safety of physical metal, if industrial demand for silver keeps rising, we're heading toward a supply-demand imbalance that can only be resolved through significantly higher prices. But here's what most people don't understand about how gold and silver prices actually move. They think it's gradual. They think prices go up steadily over time in response to supply and demand. But that's not how it works in practice. Gold and silver prices tend to move in explosive bursts followed by long periods of consolidation. They'll trade sideways for years, boring everyone to tears, convincing people that precious metals are dead money. And then suddenly, in a matter of months, they'll double or triple in price. Then they'll consolidate again at the new higher level. We saw this pattern in the 2000 to 2011 bull market. Gold would rally sharply, then consolidate for 6 to 12 months, then rally sharply again. Each consolidation phase convinced people the bull market was over. Each new rally surprised everyone who had given up on gold. And we're seeing the same pattern now. Gold consolidated for years after the 2011 peak. It went sideways, frustrated investors, convinced many people that the gold bull market was finished. But now it's broken out to new all-time highs. And based on historical patterns, based on the fundamental drivers that are in place, this isn't the end of the move. This is the beginning. The question is, where does it go from here? What's the upside potential? Some analysts are calling for gold to reach $5,000. Others are more aggressive, suggesting 10,000 isn't out of the question if we see a real currency crisis. And while those numbers might sound extreme, they're actually quite conservative when you adjust for inflation and compare them to gold's previous peak in 1980. In 1980, gold hit $850, but in today's dollars, adjusted for inflation, that's equivalent to over $3,000. So gold reaching 5,000 or even 10,000 isn't predicting something unprecedented. It's predicting that gold does what it's done before, which is serve as a store of value during periods of monetary instability and currency debasement. And the monetary instability we're facing now is arguably more severe than what we faced in the 1970s. Back then, it was primarily a US dollar problem. Now, it's a global fiat currency problem. Every major central bank is running massive deficits. Every major currency is being debased. There's no safe haven in paper money anywhere, which brings us back to that point of no return. Because here's what happens when we cross it. The paper gold market breaks. The COMEX either has to dramatically increase margin requirements or halt trading or settle contracts in cash instead of physical delivery. The premium for physical gold over paper gold explodes. What used to be a 2 or 3% premium becomes 20 or 30%. Delivery times that used to be measured in weeks become measured in months or longer. And at that point, if you don't already own physical gold, your options become very limited. You can pay massive premiums for whatever physical metal you can find. You can accept paper gold and hope it maintains its value. Or you can sit on the sidelines and watch your purchasing power erode as the currency crisis unfolds. None of those are good options. Which is why the time to act is now, while you still have good options. While you can still buy physical gold and silver at reasonable premiums. While you can still take delivery in reasonable time frames. While you're not competing against a panicked crowd. Think about what happened during the early days of the pandemic. Remember how quickly toilet paper disappeared from store shelves? How people were fighting over basic supplies? That wasn't because there was an actual shortage of toilet paper. It was because everyone tried to buy it at the same time, and the supply chain couldn't handle the surge in demand. Now imagine that scenario with gold and silver. Except unlike toilet paper, you can't just ramp up production quickly. The supply is fixed. And when everyone realizes they need it at the same time, when the point of no return has been passed, the scramble for physical metal will make the toilet paper panic look orderly by comparison. I'm not trying to scare you. I'm trying to prepare you. Because the data is clear. The trends are obvious. The warning signs are flashing. We're approaching a moment in financial history that will separate those who prepared from those who didn't. Those who understood what was happening from those who waited for confirmation that never came in time. Central banks understand this. That's why they're buying gold at record levels. Wealthy families understand this. That's why private wealth managers are quietly increasing their clients' allocations to physical precious metals. Sophisticated investors understand this. That's why we're seeing renewed interest in gold and silver after years of neglect. The question is, do you understand it? And more importantly, are you going to act on that understanding while you still can? Because we're approaching the point of no return. The window of opportunity is still open, but it's closing. The time to position yourself is now, before the crowd figures out what's happening, before the premiums explode, before delivery times extend indefinitely, before the paper gold market breaks and physical metal becomes nearly impossible to acquire at any price. This isn't about timing the perfect entry point. This isn't about trying to buy at the absolute bottom. This is about recognizing a major structural shift in the global monetary system and positioning yourself accordingly, before that shift becomes obvious to everyone. The smart money is already moving. The question is, will you move with them, or will you wait until it's too late? Will you act while you still have options, or will you be one of the people scrambling for physical metal after the point of no return has been passed? The choice is yours. But the clock is ticking. And once we cross that threshold, once we reach that point of no return, there's no going back. The opportunity that exists today won't exist tomorrow. The prices you can access today won't be available next month. The physical metal you can buy today might not be available next year. We're standing at a threshold, a moment that will define the next decade of your financial life. The only question is, which side of that threshold will you be on when the door closes?